Something really significant is happening with our retirement money, and it seems to be flying completely under the radar. The world's largest asset manager, a company that's almost certainly a big part of your 401k, has quietly started moving trillions of dollars. So let's break down what's really going on, because this isn't about chasing the latest news cycle. It's about understanding where the smart money is actually heading. The number itself is just staggering. $2 trillion. Let that sink in for a moment. To put that into perspective, this one single move is about 1/7 of all the money that BlackRock manages. This is not some minor adjustment or small portfolio tweak. Oh no, this is a massive, decisive, strategic repositioning by the biggest player in the game. And here's the absolute crucial point. They are shifting that $2 trillion of exposure out of the United States and into non-US markets. Now, when an institution of this size makes a move like this, it's not based on a gut feeling or a guess. It's all based on hard data, on policy, on probabilities. They are seeing something that maybe the rest of us are missing. Okay, so this brings us right to the most important question for all of us. What in the world does this mean for your retirement savings? Because BlackRock is such a fundamental piece of most 401k plans, their strategy has a direct impact on your financial future. And that is the question we are going to dive into right now. All right, let's get into section 1, the reasons for rotation. To really understand why this is happening, we've got to look past the day-to-day headlines and get down to the hard data that's driving these huge institutional decisions. Let's start with simple performance. Last year, the S&P 500 had a solid year, delivering a 16% return. Not bad at all. But, and this is a big but, look abroad. Germany's main index, the DAX, was up 22%. Japan's Nikkei, it surged an incredible 26%. The numbers are pretty clear. The momentum for growth is really picking up speed in other parts of the world. But the story doesn't stop with just stock performance. There's another really critical factor at play here, and that's currency. Over the last year, the US dollar actually lost about 10% of its value. Now, this is a huge piece of the puzzle, because for any American investor, your returns aren't just about how stocks perform, they are fundamentally tied to the strength of the dollar. This weakness in the dollar creates a really powerful effect that the pros call a currency tailwind. Here's how it works. When the US dollar gets weaker, your investments in foreign countries, which are held in their currencies, actually become more valuable when you convert them back into dollars. So you end up getting a kind of double return, one from the investment growing and a second one from the currency itself getting stronger against the dollar. So to quickly recap the main drivers, it's really a combination of things. The big institutions are seeing better returns overseas, plain and simple. They're seeing a weakening US dollar that gives them that extra tailwind. And, well, there's a general sense of policy uncertainty right here at home. All of this together is pushing that capital to look elsewhere for growth. Okay, so that brings us to section 2, where capital is flowing. If all this money is moving out of the US, the big question is, where is it actually going? Let's take a look at the specific places that are attracting all this institutional money. Here are just a few examples of where that capital is ending up. You've got funds like VWO and IEMG, which focus on emerging markets. Why? Well, they have younger populations and faster-growing economies, and they return 25 and 34%. Then you have something different, like the fund EJW, which focuses just on Japan. Investors there are really rewarding things like stable government and corporate reform, and that led to a 24% return. This quote really nails it. Every global rotation feels uncomfortable before it feels obvious. Think about it. By the time a huge shift like this makes the evening news, the biggest opportunities are often already gone. The big institutions, they position themselves during these quiet, sort of uncomfortable periods, long before the trend becomes obvious to everyone else. And on that note, if you're finding this explainer valuable and you want to stay ahead of the curve, please just take a quick second to like, share, and subscribe. It really helps us continue to bring you this kind of analysis so you won't miss any of these important updates. All right, so that brings us to section 3, the long-term strategy. We've talked about the what and the where. Now let's talk about the right way to think about all of this from a smart, long-term perspective. First, let's be very clear about what this is not about. This is not about abandoning U.S. stocks or panicking. The U.S. is still going to be a powerhouse of innovation. Instead, this is about strategic diversification. It's about recognizing that global growth leadership is shifting and positioning your portfolio for that reality. BlackRock isn't trying to predict the future with a crystal ball. They're simply responding to the data and following where the money is already flowing. This brings us to our final and maybe our most important section. What are the core risks of not paying attention to this massive shift in capital? Let's break down the 3 biggest risks of just doing nothing. So the first risk is just ignoring the trend altogether, basically betting that the biggest, most informed player in the market has it all wrong. The second risk is waiting for certainty. By the time a trend like this feels completely safe and is common knowledge, while the best returns are usually a distant memory. And finally, the third risk is just a lack of diversification, having too many of your eggs in one country's basket at the exact moment the global landscape is changing under your feet. So we'll end with this question for you to think about. The goal isn't to perfectly predict the future. It's much simpler than that. It's about following where the smart capital is already going. You don't have to be the first one to the party, but you certainly don't want to be the last to leave. So the question is your portfolio really prepared for a changing world?